Hi, Dudley. Good morning.
Oh, you're right.
I'm well, thank you. How are you? How you doing?
Not too bad. Not too bad. Busy. Other than that.
Good stuff. Good stuff. Hi, Natalie. Good morning.
Morning, Ian.
Hi, how are you?
I'm fine, thank you.
Great stuff. Great stuff. Cool. Hi, Hannah. Good morning. Ah, yes. I mean, I was also I also I mean I downloaded the Zoom app on my phone, so that's another thing I could recommend. If not for today, hopefully everything should be smooth. Where sometimes on the phone you can almost, or are you logging in from your phone anyway? For some of you, or is it via your laptops? Probably depends. You might already be just using it through the phone. But yeah,
Laptop, Ian.
right. Okay. Sometimes if you could almost do a two-way thing where you could be kind of watching it on the phone, just because sometimes with the phone it's a bit more it's a bit more fluid, but it's a bit more, the internet works better somehow on mobile devices sometimes compared to the laptop. But cool, great. Hannah, can you hear me, Hannah?
Yeah.
Oh, great. Hi there.
Hi.
Hi, how are you?
I'm good, thank you. How are you?
I'm well, thank you. I'm well. Cool. It's just James now. It's just James. Yes.
Oh,
Yeah.
is Mark part of this class?
No. We we haven't heard from Mark. We extended the invitation to him, and no, he's not. I suspected maybe the program hadn't quite worked for him.
Right.
He's far slightly the distance, the travel. Maybe it just wasn't. And also because, of course, he probably was already behind. Remember, he hadn't sat F5,
Yeah.
so probably thinking he wanted to deal with, and if he did sit F5 in March, I don't know. So it would have been a question of maybe wanting to tidy things up, and now with this as well, with everything kind of moving online, because he probably thought, no, maybe not. I don't know. So no, yeah. It's but we have Hannah. Hello. So we have our balance again of about 5, 6. There's always been Graham as well. Where's Graham? Oh, right. Where are they? There's Graham, and so there's a balance of 5, which is a good balance. Okay, we'll begin. Let me just. I have email. I did copy Graham in and James in on the invitation. So let's begin. And the good thing, at least now, is that there is a it's okay. The good thing is that at least thankfully the internet is much better today. So let me see if I can share my screen, and we'll start. Okay, great stuff. Can you see my screen? Like a little record player or something like that.
Yep.
Yeah.
Brilliant. Awesome. Right, good. So we're on chapter 5 of our textbook. And we're moving on to talk about risk. So I recorded of course, as you saw, I recorded the videos on ethics and acceptance. Thank you, Natalie. I've replied to you. You might not have checked your mail yet, but I've sent your feedback on the question that you did. So we're going to be carrying on with risk today, just kind of taking that in. We'll only have morning classes. I mean, I think we're well ahead of schedule technically, given that we're doing the exams in September, and we're carrying on, and the classes are recorded. So if peradventure you can't join us on a particular Friday morning, it's okay. You'll just get the recorded class. Right. So ethics and acceptance, and as usual, please tell me if there's any sort of issue with the hearing. Let me just get this right. Here we are. Oops, sorry. All right. Wait. All right, Here we are. Okay, great stuff. So let's let me just go back there. All right, good. This is now working. Very good. Okay, great. So risk. So I'm starting at page that's page 101 of your textbook. And the issue here with risk here is that fundamentally we're trying to give an opinion here where so much judgment is being made. That's the first thing. And the reason why, again, so much judgment is being made is that, and again, I'm focusing purely on the audit, the assurance engagement of the audit, the audit of, and we're very clear in what we're talking about when we talk about an audit. We are looking at the financial statements, if you like. And so with the financial statements, even within the financial statements, there is a lot of judgment that goes into the, if you like, arriving at the final figures that make the statement of financial position in particular, and even a lot of judgment that goes into making, if you like, the figures in the statement of profit or loss, the income statement, ranging from, really doesn't really matter, from write-offs from provisions, if you like, even the accruals concept, if you like. So you can see those figures aren't real per se. When I say real, they're not cash figures, they are accrued figures. The income statement is an accrual statement in effect. So we already have this possibility of opinion being, you might differ from me on a range of things. We both might just differ as to whether or not the accounts are true and fair. So also the second thing again is because you could have a really big, large company that has, you can't quite possibly examine every possible balance and every single entry that goes into the balance. And even if you could, it'll still be too risky to just sort of give absolute assurance. So when we go into do an audit, or look at any organization's financial statements to sort of agree that the accounts are true and fair, we need to kind of understand kind of the organization that we're dealing with and understand the risks involved, so that when we plan the audit, we're able to catch the risks. So again, the good thing about our work is that we have benchmarks, which is the International Financial Reporting Standards, fair enough, but we have a very clear document that we are looking at. So let's talk about let's talk about how risky, for example, turnover is. I mean, of course, you'd want to know what this business was in, what they're trading in. If you like, you see that you and I know there's no point saying that. I mean, the classic example I like to use is the case of fidget spinners. I remember when fidget spinners came out. You know, I just one day woke up and I saw fidget spinners everywhere, and then the next day I didn't see them anymore. So the question here is that, yes, we might say that the accounts are true and fair for the past, but we're also giving a signal about the future. So we want to sort of say that we believe that this organization will remain a going concern being very much one of the fundamental concepts for within the financial reporting standard, IFRS. It's not a fundamental qualitative characteristic, but it is a secondary one, that this organization will remain a going concern. So you can see that we really need to understand the organization, because if we're going to be signing off that the accounts are true and fair, sorry, I just want to make sure that I don't miss any of the lads. Okay, if they come in, if we're going to be signing off that the accounts are true and fair, then we want to make sure we have closely analyzed the risks. Now, again, I mean, this is just a picture. Many organizations will come to this when we look at I don't think we looked at much of this in performance management. When we look at strategic business leadership or just any type of management program, we'll always look for ways to document risks. And many organizations will have things like risk registers. They will have things like risk assessments to just find a way to decide which balances are risky and which aren't. So typically, again, you don't have enough time. Imagine you only have a week for the audit. You want to go in there, you're looking at your statement of financial position, you're starting at the top. They've always only had one building, you've always been there. So you're not going to spend all day on that. Not a very risky balance. It's not as though they've, if you like, borrowed some money and it's become security. You would ask and you would check, but most of the time that's it. So, but there might be certain balances that you're thinking, this is a very, here, James is here. You're thinking, hi James. Good morning. James? Okay. Can the rest of you hear me, by the way?
Yeah.
Yes, Owen, very clear.
All right, very good.
Hi,
Okay.
James.
Hi, Ian. Sorry, my computer decided to update.
No problem, as long as you can hear me. That's
Yeah,
the
I can
that's
hear
the
you.
worry. That's the thing. Okay, great. So the question here is that I was talking. So the question is, we don't have that kind of time. So you can see an audit is very much about this judgment of, I only have a week. I have 3 members of staff. Maybe I have a first year audit junior. I have a sort of a second year, and I'm here. And we need to share this work in such a way that I give maybe the least risky balances to the guy who's just coming in at their first year, because they can literally go and verify that certain assets exist. If you like, they've seen them. I've seen it. It exists. They can go in there. They can see, oh yes, I'll do the valuation. I'll look at the initial invoice when this thing was bought. I'll calculate some depreciation, if you like. So your classic assertions in audit are typically, like anything, on a statement of financial position, that this thing exists and this thing is valued at this amount, if you like. So that's the kind of fundamental understanding of agreeing a figure on, if you like, a statement of financial position. So we need to decide which balances, to a certain extent, are risky and which ones we're going to sort of pursue and spend more time on. Inventory, as you can imagine, is just one we're always going to be spending time on, just because we'll talk about it as we go along. So audit risk, this is really about risk. And what is audit risk? Like I say, when we even say these statements, when we say the accounts are true and fair, we say that that these accounts are true and fair, that we haven't found any material misstatement, which means to a certain extent we are accepting that there will be some error. But what we're ultimately saying is that this error is tolerable. This error will not affect you as an investor. It's minor. When I say minor, within the question of materiality, because we accept that there will always be a few things we missed out on, because we did not examine everything, because we took a risk-based approach by looking at the riskiest balances on the statement of the financial position to spend a lot of time with, and we had to make some judgment and assumptions. And even if we disagreed to within a certain boundary. So audit risk is that overall risk that will be set by the audit partner. He might say, listen, I'm happy to accept an audit risk of 5%. I'm happy to accept 5% of, if you like, of overall as an error, and that's it. And the question really here becomes then, what is audit risk made up of? So you don't have to start working on, you're not going to get that kind of the figures in terms of, oh, make it 5%, or no. It's just an understanding, a very clear understanding of what audit risk is. And audit risk fundamentally is the risk that we as auditors would give the wrong opinion, or, forgive me, not wrong, an inappropriate opinion. So in other words, we would say accounts were true and fair when they weren't, or the other way around, we could say accounts were not true and fair when they are. So the question is, how do we prevent a situation where we do not give the wrong audit opinion? And so fundamentally, audit risk is made up of 3 risks, right? 3 key risks. It's this idea of IR times CR times DR. It's less the times, it's more the fact that audit risk is a function or depends on 3 key risks. Now, the first risk, if you like, we'll come back and look at it, we'll expand on it, is this idea of the inherent risk. And this inherent risk, it literally is in the meaning of the word. There's nothing that you and I could have done as auditors. There's just nothing. It's in the nature of the business. So, for example, a business might be dealing with with inventory that literally goes obsolete within, I don't know, weeks, if you like, perishables. So there is a high risk of misstatement by the very nature of the products the business is working with. The business might be working in a very volatile business environment. They might be working with very sensitive financial instruments that are constantly fluctuating every day. The very nature of the trade in itself leaves the business exposed to these, if you like, external shocks, so to speak. So the question here is, I mean, of course, on the opposite side, we can have very stable businesses where a business will deals in government contracts, maybe schools. They know the certain number of students that come in. So when I talk about inherent risk can affect could be to do with its revenue, if you like, in terms of when the money comes in and who they're trading with and who their customers are. It might be to do with the actual inventory. So fundamentally, these are the key drivers of how, in the nature of the business and the organization itself, where are the natural problems that we have to go in and then manage, or still coming to some kind of agreement that, listen, this is very volatile, but we're going to have to check more. So you can see that the higher the inherent risk, that we're going to have to do more work. The other issue with inherent risk, I mean, there's a number of examples or cases of examples of inherent risk, is that sometimes you have a very dominant owner. And people say that a dominant owner literally will kind of not just override what they need to do, but it's very difficult to get what you need from them. They determine the direction. They take risks generally that other people won't do. I always use the owner of Newcastle United, Mike Ashley. You know, he takes some very crazy risks, and sometimes you just think, wow, he's already a volatile character. This is something we need to think about. You know, we'll buy that and buy that. So little things like that. So the point is that inherent risk is very much integral or within the organization, and that's one risk that we have to one bracket of risks we need to think about. The next set of risks is this idea of what's referred to as the control risk. Control risk literally means internal controls. Are there good internal controls that we can rely on? Now, together, the risk of the nature of the business and whether or not we can rely on the inherent risk means or will determine how many mistakes, or if you like, how much material misstatement we are likely to see. I mean, internal controls, again, I highlight the fact that remember that we are focusing on the financial statements. And when I talk about the financial statements, I've said it before, there are typically 6 key systems. There is a sales system, so literally what happens from when an order is placed to us delivering the order. There are processes right through, if you like, and in audit we would call that a walkthrough. So typically I would literally take an order and walk through everything that happens to ensure that that order is not only fulfilled, but that it's not a fraudulent order, or it's not duplicated or done twice, if you like, and that sort of thing. So typically the controls in place, the authorizations in place, the additions in place. So for example, I don't know, if you're duplicating, you can see straight away that I'm going to probably have revenue showing us twice the amount that it really should be. Are there returns that are coming in? So when I talk about revenue, I mean, again, I'm talking about in audit terms. I'm not just talking about revenue. I'm talking about revenue. I'm talking about sales returns, if you like, and I'm talking about discounts. So all those things can be manipulated if you really think about it, in order to decide whether or not the revenue figure is correct at the time. So I need to check the controls on all those 3 things, if you like, and would document that. And here's the thing: if I can rely on the controls, if I walk through and I can rely on the controls, and the controls are working, then of course I'm less likely to find material misstatement. I'm less likely to look at individual invoices, which I referred to last time as test of detail. So I said the tests we carry out in audit are fundamentally 2 tests: tests of control and test of detail. So I want to be able to rely on the controls within the organization. And again, I talked about this dominant owner. When we talk about controls, we'll see, we talk about the culture of controls. You can have wonderful controls in place and have no one follow them, if you like. You can have people who override them. And as a result, that's still very much part of control. So once I have that all documented, then I'll know to what extent I can rely on the controls. So we typically argue that the inherent risk and the control risk together will combine to make up this idea, will determine the risk of errors or material misstatement that we are likely to see. Finally, the third risk is a risk, if you like, unique to us as auditors. Now, detection risk is what this is really called. And so ultimately, think of it like this. You could have someone who just literally joined the firm, go and do an audit. Now, this business might have very good controls, no inherent risks. And of course, you need to make sure that the person who's going to do the work is capable or has the professional competence, if you like, to do the work. So there are risks of us not sending the right people who are able to test what it is we need, if you like. There's no point someone going along and I want to know whether or not this business has 10 buildings, and he goes along and starts looking at inventory, or he goes along and he looks at the wrong inventory when I want him to look, or her to look at a different type of inventory. So this question of, are we capable of doing the job, is really what's going on here with detection risk. And then, of course, even within detection risk, when we come to look at it, there's the kind of unlucky kind of scenario that arises. So for example, let's talk about inventory. A business might be recognizing inventory at the higher of cost and net realizable value. Now, we have a standard that's very clear. You need to recognize inventory at the lower of cost and net realizable value. Now, imagine there are 100 items, and I decide to sample, say, 20 items. Now, this business might actually have within its, I'm just going to go for the extreme case where 80 of those items have been, I mean, that's very unusual, but just to really make the point very clear, 80 of those items are, if you like, currently recognized, if you like, at the, let's just say, higher of cost and net realizable value. So wrongly valued. It should be valued at the lower of cost and net realizable value. 80 of them wrong. And I go along and I pick the 20 that have actually been valued at the lower of cost and net realizable value. I pick the 20 of them, pick my sample, and then I say, wow, look, I've picked 20, and all of these 20 are recognized at the lower of cost and net realizable value. Therefore, because that's what sampling really does, isn't it? We take the sample and then we project on the entire population. And then we say, oh, therefore the whole population, I haven't found any errors. Probably is recognized at the lower of cost and net realizable value. So that, in effect, is a very unlucky error, and we call that a sampling risk. It's just the risk of sampling, the risk that you pick, like you toss a coin and you've picked the wrong one, and it's unfortunate. So the two errors I've talked about there, detection risk is made up of those two things I was talking about. The first thing I was talking about is referred to as non-sampling risk, where we don't have someone who's professionally competent to do the job, and we have sampling risk where you were just unlucky. Okay, great, cool. So let's carry on. Yeah, so this is just what I was saying. The risk of material misstatement, this is within the organization itself, has nothing to do with us. Remember, we don't build the internal controls for the organization. They build their internal controls, made up of inherent risk and control risk. Now, like all things, the whole point is that, yes, it's possible to have a lot of errors or potential errors by virtue of the nature of the business. Just like it could literally be anything. It could be the fact that I mean, I'll give you one of these, an example once. I remember there was I can't call it it wasn't really an audit, but it was a mixture of accounts prep with a kind of review work. And it was they used to make these, the vending machines. That's what it was, the vending machines. Now, what I thought was interesting was that the guys who managed the vending machines would go out to the vending machines and bring back all the money from the vending machines. And I just happened to be at the premises that day, and they just bring all that money back, and they just somehow, I don't know, they just pour out the money from the bags and leave all these coins on the table. And you would have all these coins on the table, and people would be working around and just, working away. And I just thought, wow, there are major inherent issues here, if you like. I mean, there's the risk of theft, because these are all coins that are easy to pick up, if you like. Now, of course, there's a if you like, there's a list, a purchase list, if you like, of the food that's been bought through the vending machines that comes with the money. And yes, that was with the bag. So if someone is regularly checking that, so to speak, to the coins, then they would pick up if there were differences. And that's kind of a control measure to ensure that, yes, all these coins are there, and those will prevent the theft of money. So in effect, you have inherent risk with all its errors, potential errors. And it could be anything. It could be maybe someone who's just new and putting on information onto a computer system. So like batch, if you like, batch inputs, and someone's putting that. Now, they could have put errors. They could have typed in an extra zero and whatever, but before they press send or enter, if you like, the computer itself adds up and it says, no, there's an error here, or stops you from only ever doing, stops you and only wants you to do 10, or before you can press a certain amount over 50,000 or whatever it is. So those are controls that kind of prevent the potential for errors, because errors are possible. There's nothing we can do about that, especially if there are a lot. So this is the relationship between inherent risk. It's natural. There's nothing we can do. We don't stop trading because something is risky. It's always ironic. I always laugh because you will see people say things like, oh, Syria is a war-torn country, or these people fly there, well, until now, fly there to trade, fly there to buy oil, because of course there's still potential for business, but they put insurances in place and controls in place. So we will always have risks in any organization. We need to put in controls to prevent. We could go on all day talking about within even the banking sector. I think I talked about when you might remember my very first class when I talked about by putting in controls in place with certain trades to make sure that people have limits. So if you do some share buying or share selling, you will have what's called a margin account, and after a certain amount you can't invest anymore until you clear out your margin account, or you overdraft, if you like, because you might make the business more and more losses. Anyway, finally, we have detection risk, like I say. So this is you doing your own work to then catch any other errors, and then having those errors changed or amended by the organization. So in effect, we finally arrive at our audit risk. Okay, right. Let's carry on. And this kind of highlights the same thing. All of these just highlight those big points. Right. So in this process of risk assessment, because this is what we're really doing, this is a risk assessment exercise, we need to decide a couple of things. We need to decide, I guess the term I always like to use is, how low can we go when it comes to materiality? How much am I willing to forgive? So the classic term, or the classic way of looking at materiality, I mean, we're going to talk about that at length, is to sort of is like this: I don't have time to test everything. In fact, when WorldCom collapsed, I'll discuss this and explain, hopefully give you context. I don't have time to test everything. So I'm going to have to make some kind of allowance and say, listen, anything below, I'm not interested. I will only test for errors over a certain amount. Now, of course, again, the question here is, the more I trust you, right, the more likely I'm likely to have a much higher figure. I'll say, listen, anything below, I don't know, whatever, 100,000, I'll only look for errors above 100,000, because I trust that you would have done well and made sure that, because I trust your systems, I've done my walkthroughs of your controls, so I will only look for invoices with errors over 100,000. Because you have good controls in place. So I'm trying to minimize the work I do. As opposed to, if I didn't trust you and I felt you were making errors on even £100 invoices and £200 invoices, I'd be like, no, listen, any errors over £1,000, I want you to tell me. If you find it any, so basically you see an invoice over £1,000, if it's 1,005, pick that up. Anything under that, ignore it. If there are errors there, I'm happy to accept. I'm basically happy to accept errors below a certain amount, and I will not accept certain errors over a certain amount. And that's really the case for materiality. We'll come back to that. And then we'll talk about the actual risk assessment procedures, what procedures we actually do. This starts to lend itself gradually into looking for evidence, if you like, and there's certain things we do. I'll come back. AEIOU is very much a mnemonic for remembering the procedures we use, even when we look for evidence. You'll see me. I'll talk about this again. AEIOU discusses the actual things we do, and those words AEIOU: analyze, examine, inspect, observe, recalculate. Those words are the words you must always use when you start your sentence. That's what the examiner is looking for you to say. So, I mean, I'll say it over and over again. We never use the word check in audit. We just don't. So don't ever use the word. The examiner doesn't like it. It's not really, check means nothing for anyone. We actually have to do something. So are you analyzing? Are you inspecting? Are you observing? Are you recalculating? Are you examining? What exactly are you doing? So we'll look at that procedure, those procedures as we go along. So materiality. So what I'll do is I'll move through this and then kind of break it down a little. And what is materiality? And sorry, so that's what I was just saying earlier on. This question of materiality and analytics. The analytics are really to do with those risk-based procedures. But we'll come back to that. Those are the main things: materiality and kind of the AEIOU, and the A is for analyzing, and we'll see. You already do it. When I say you already, you've done this before, where you're looking at last year compared to this year. You're looking for trends, you're looking for anomalies, and then to make a decision whether you actually think a balance is something you should spend time looking at, or you're wondering what's happening there. Okay, great. So I'll breeze through this. I've already spoken a lot about this, and I'll just kind of go through them slightly quickly. My aim is to gain absolute assurance. I'm trying to bring the risk of giving the wrong opinion or an inappropriate opinion down to an acceptably, sorry about that, these things keep coming up, to an acceptably low level. That's my plan, to bring that to an acceptably low level. Again, I've said all this. I'll move pretty quickly. I don't want to give the wrong and inappropriate opinion. I mean, I already kind of, last time we spoke about that. In order to do this, I have to get sufficient appropriate evidence to bring that down to a low level. And as I said earlier on, the very first thing that I must do in my risk assessment is to understand the entity and its environment. So the first thing you will see is that typically when you look at an audit file, and hopefully by the time we get to evidence, I'm trying to get, it'll have to be an e-file, because typically if we were in class, I'd get a little audit file for you, and we're just going to look at some of the tests and see what's going on. It's going to have to be an e-file. We're going to have to do it that way. Be interesting. You'd see at the beginning of every audit file, kind of, you'll see a section just on the, if you like, the sort of the background of the organization. So someone, probably the audit manager, would have spent some time, or someone who's about to qualify would have spent some time actually doing some research on the organization. And what I mean by that is you want to have a good understanding of this organization. You see, it just gives you the right, think of being a bit of think of it like being a bit of an inspector. If you don't kind of understand the business environment, then you won't know where you want to know what it is that someone is likely to kind of manipulate, or what is potentially coming, so you know what could be manipulated, what balance there could be under pressure, given what's in the external environment. Again, so we're ultimately trying to find the risk of material misstatement. Again, like I said, we are looking at, sorry, let me just go back just to be sure. Yes, I'm going in the right order. I thought this was going to take me somewhere else, but it's not. Okay, great. So we're trying to look for the risk of material misstatement. Again, I've sort of highlighted this, those figures on the statement of financial position and assertion levels. So the two assertions I've mentioned so far, this idea of an assertion, you see, is what I said earlier on. And again, hopefully you're better and better seeing the framework. When you look at a statement of financial position, the directors are saying a few things. They are saying, let's just go to non-current assets or inventory. They are saying two things, or many things actually, about 4 or 5. I'm going to focus on 2. They're saying, first of all, these assets here, these non-current assets exist. That's the first thing. They exist. And two, the second thing that we'll come to talk about is that they belong to us. You might find that funny because you would wonder why anyone would show, but it's very possible. They might be, and when I say they belong to us, they still belong to us. There's no contract selling off some assets and we've hidden the contract selling it off because assets make our statement of financial position look good. So they exist, they belong to us, and that is the value, if you like. And all of them, so talk about completeness, they're all there. So you can see that from an audit point of view, our focus is very much on you are asserting, you are saying that these figures are what they are, they exist, you own them, they are valued at that amount, they are complete, if you like, and they have been classified correctly. They are all in the correct classification. I can trust you. That's what you're saying. Nothing's left out. Or when I say complete, you haven't put too much in and you haven't taken much out, and you can see why. If I was talking about liabilities, you would want to not put all of them in. If you were talking about assets, you'd want to put more things in. And you might be wondering, but Owen, are there assets I could want to put in? Contingent assets, for example. You might have some money coming to you. We're not quite 100% sure, and we have guidelines as standards on how we recognize potential funding or potential money coming to us. My risk assessment will then also move to try. So part of my risk assessment was trying to understand the organization as a whole, trying to understand its business again. And trying to understand the business as a whole is me trying to understand the inherent risk, if you like. I'm trying to understand what the inherent risks are here. And then, of course, I'm also trying to understand the business's internal controls, because this will determine how much detection work I do, right? This will determine how much detection work I do. So this was the slide I was trying to get to when I was talking about trying to understand the inherent risk in this organization, the external environment, what is likely or going to affect this organization. I mean, we could go all day about our high streets and the move to online shopping by people. We could talk about tax policy, government stability, just the kinds of things that businesses which started on one day, John Lewis, so many businesses that have lost their space on the high street just because they've not been able to transfer their trade online as efficiently. And you have new businesses coming up. So having an understanding of this will help us design or focus on what balances we expect to be true. So for example, revenue, imagine a business year on year, we see that the entire industry is decreasing, and yet they keep showing an increase in revenue. We need to ask the question that what is going on here? Is this truly, why are you breaking the trend? So we're ultimately trying to understand the trends here first. We're not accusing anyone, we're just trying to understand the trends. Also, we're trying to understand what's going on within the organization generally, if you like, and this helps us not only for from a HR point of view, but also from a kind of controls point of view. Now, let me just speak from a controls point of view first of all. Imagine an organization loses its financial director. I think you get questions like that, where an organization loses its financial director. Typically, they tell you they lose the financial director close to the year end or something like that. Now, you and I know there is a recipe for disaster, because what you now have here are potential items that have not been accrued for, potential items that just have not been put through. The question here is who is able to get, because they're going to give you a set of financial statements. How can I even trust that these figures here are even complete, so to speak? That's the first thing. But even from a management point of view, if you lose certain key management personnel, then, and they've not been replaced, then you're trying to understand the reasoning for maybe why events have happened with revenue, or why they've not done as well as they should have. You're not trying to solve their business case, you just want to understand the organization. So it's just really important to understand. You know, sometimes when I talk about key management personnel, I'm sure, as you know, hold sometimes the key contracts for sales or for revenue. So typically when a key management personnel leaves, typically he would take his clients with him, and that might affect the organization. It's just making sure they report on it. We're not there to judge, we're just making sure that they say, listen, it was 200 last year, it's 70,000 this year. yes, you're not saying it's 200, it's still 200. No, it's 70, and we know why. Right, and again, so we're trying to identify the risk of material misstatement. And now that we know this, this will now guide us on how much testing and procedures we will do, if you like, test of detail. So the key thing is that even if controls are amazing, even if we do tests of controls, and the key tests of, when I say key tests of controls, the process of doing controls, like everything, is to walk through the systems. I talked about a sales system, there's a purchase system, there's a wages system, there's an inventory system, there's a cash system, and there's a kind of non-current asset or capital acquisition system. When we want to buy capital assets, what's the process that we have in place? And we literally walk through all of that, and everything's perfect. We would still carry out some test of detail. In other words, some substantive testing, if you like, of certain invoices, just to make sure that the numbers are accurate, and if you like, they did exist and they did happen, if you like, and that sort of thing. So this is what I was talking about, this question of here, that I want to understand. I mean, so this is what is a misstatement. So this is where I'm just going to take inventory. Inventory is always a good one to work with. Inventory, that's the amount there. I think it's so easy sometimes to forget that when we come to do audit, we can be auditing a range of businesses. So let's look at manufacturing businesses. Manufacturing businesses will have a number of things. They will have, and I mean, it is a headache. I mean, if you've been out doing any type of audit work on manufacturing industries, because they will have raw materials, they will have work in progress, which is measured based on the amount of labor that's gone in, if you like, and the amount of raw material that's been used. I mean, and then finished goods. I mean, of course it'll be bliss if it was just finished goods, but how do we get work in progress fairly measured? It's a headache, because some could be 35% complete, some could be 75% complete. It's just based on the judgment of the senior managers. Do they even have a process for managing work in progress? Do they make so many assumptions? So you can see why inventory is just the most annoying balance on earth to do, because of all that potential for manipulation within work in progress. And and again, like I say, we could go on. You inflate your inventory, gross profit will look good, current assets will look good. Fair enough, it will affect you the following year, but who knows? You might be there for the year, so you've got your bonus and you're off. So yes, and that's the figure, and and I'm just talking about classification, right? I'm just talking about classification. There's everything to do with controls, if you like. There's everything to do with controls of theft, or preventing that. There's to do with cost versus net realizable value. And the whole idea of cost versus net realizable value is that many organizations use their own method to even do their costing. So there's something, I'm sure you talked about it when we did performance management, standard costing, if you like. And so the question here is, the standard costing is allowed within the standards of measuring or using to measure within the international financial reporting standards. So we just need to be comfortable that we understand their method of standard costing, to kind of say, okay, listen, I actually understand how you guys have arrived at your final figure for inventory. I am happy that that figure is true and fair. But then again, like I say, you might have people who are not competent, who are telling you have 50 boxes as opposed to having certain number of boxes. Again, it's just all a matter of time. There's a time I was doing an audit in I think it was in London, for a business that they made suits, and the reason they had a figure for inventory, for when I say as part of the inventory, for their ties, and they had this storehouse full of ties. Now, the funny thing was that this storehouse full of ties, the reason I had to go was because I wasn't actually going to do a stock take. I had to go and see them as something else, was because ironically, the figure for ties hadn't changed for so many years. I think 3 years. And that was because they had all these old ties that they just hadn't sold or shifted. So now the first thing was to actually just verify the number of ties, but there were hundreds of ties. So I think I spent my whole afternoon just counting ties. First of all, ties that we should really have been writing off, but I had to first of all verify the number of ties first. I'm like, okay, I've got the right number of ties. They exist. Now let's value these things. They're worthless. But of course, they weren't happy about that. Right. So this is also issues we could have with inventory. Typically, numerical errors, judgment about cost versus net realized value. Typically, FIFO, AVCO is what we're going with, standard costing. It's we don't use LIFO here in the UK. It's not our thing, and it's a. We'll come when we talk about reporting. Once you start using FIFO, you might remember it from your days of accounting concepts. You have to stick with your accounting concepts. Sorry, your accounting policies. So once you choose a policy, you have to stick with that policy. It's a standard, because as you can see, we need to be able to compare one year to the next. If you decide to change your policy, you have to go back and change all the figures based on that new policy you're implementing, so that we can compare fairly. So you can see how these things tend to have a problem. Like I was saying earlier on, I'm only taking samples and then I project based on those samples. So it's really important to be to get it as close or as right as possible with your sample, because if you're saying there's 2 mistakes out of 10, if there are 100 items, in effect, we're technically saying there's 20 mistakes out of 100. And the question is, how many items am I willing to tolerate? Maybe you said, okay, listen, I'll tolerate anything less than 3, and that's fine. I'm willing to accept, well, 3 per 3 so sorry, 15, but whatever, just project in the ratio of 3 per 10, whatever, that sort of thing. It's just projecting. Again, we've already discussed this question of misstatement. And yes, I mean, again, this is just repeating everything I'm saying here. All I'm trying to do is prevent the risk of misstatement. And I'm trying to make sure I carry out an efficient and effective audit. I don't want to give an inappropriate opinion, and I don't want anyone to come back and sue me. I think if you noticed in my video last week, I talked about the engagement. When I was training, we never had the what you could sue us up to. Now, many as part, I mean, remember, it's a nice one, it's an easy one, and it's very possible. Typically, when you start doing audit, the exam questions, you will notice that they always ask you an initial 4 marker, like a 4 or 5 marker. They just give it to you there. It's all knowledge, straight knowledge question. And then you have a bigger question, maybe 16 marks, asking you to read a scenario and pick out issues and then discuss blah blah blah. But those knowledge questions, classic. What do we expect to see on an engagement letter? An organization's change from one year to the next. So everything from fees to the purpose, the scope, if you like, who's in charge, if you like. But what's really interesting, the timetable, what's really interesting with this question of a good one to always put now is you will see people say, listen, you can only sue us up to X amount, if you like, if things go wrong, because now many people can come back and sue auditors if they feel that the audit wasn't done properly. So materiality, we talk about materiality now. This question of, again, how low can we go? What am I willing to accept? Is the fundamental question about material misstatement is that if this thing isn't there, will I, as a user, be misled? If you omit this, will I be misled? And that's really the case of material misstatement. Would I be misled, or should I know about this? So when we talk about materiality, we're talking about amounts, but we're also talking about qualitative issues. So you might need to disclose. I want us to really think about materiality, not just from it. We tend to do a lot of numbers and say, okay, listen, I'm looking at inventory, I'm willing to accept this amount. But no, even to the case of disclosures. So when you do your audit, you don't just audit the financial statements and you look at the income statement, statement of financial position, you look at the statement of cash flow, you look at the notes and the disclosures as well. Have they openly told us everything that could possibly, or should I say probably happen? Sorry, possibly happen. So law case, I don't remember who was celebrating last time, but I think I remember giving you the scenario of you guys going out for dinner and someone falling and breaking their head, and potential contingent liabilities need to be disclosed. So if it's not disclosed, those are material issues. We need to be highlighting them. Right. Sorry, I don't know why I keep having that. I need to take out that fish. I don't know why I've got that, but I have it in there. I need to kind of understand why I chose to pick that. I think it was it's a stray. Anyway, misstatements. So misstatements include omissions, if you like, potential omissions that can influence our decision making. I've just kind of highlighted that individually or in the aggregate. Adding them all together can affect us and the decisions we make. Now, so like I said earlier, so let me come back to the quantitative. Let's focus on quantitative. I kind of highlighted earlier on that you and I might disagree. I might look at your inventory, right? And inventory will say, I think your inventory should be 2.5 million. You think it should be 2.6 million. Depending on my materiality, my materiality will be like, Oyen, you're willing to accept an error, total errors across the entire statement of financial position of 500,000. Big company now. No, so very bigger. So say 20.5 million, 20.5 million, and I think it should be 20.5 million. You think it should be 20.6 million. You've calculated everything, and it's 20.6 million. You got there, and I've done everything myself, and I said you should write off another 100,000. I mean, and I make my written recommendations. You should write it down. You should write it off. But because my overall materiality might be 500,000, it's within my kind of space. I'm willing to forgive you up to 500,000. I'm still going to say the accounts are true and fair within material. If you like, there are no material misstatements. I mean, there is misstatement of 100,000, but it's not material. So I'm willing to accept. Yeah, it's okay. 50,000. It's all right. It's not going to affect the user. If you like, it's not going to affect what they think about the accounts. It's only if it crosses the 500,000 threshold that I'll get upset and I'll be like, no. But saying that, that's for issues where there's judgment. As you and I can imagine, it is impossible. I don't know. I'm sure all of you have had to do bank recs. The most upsetting thing with a bank rec is if you're missing a penny or 2 penny here or 3 penny, 5p. When it comes to audit, there's just no materiality with bank or cash. There's just nothing. It's just nothing. It just has to balance. Sorry, there's no materiality. So the questions of things like materiality don't arise with bank or cash because for us that's theft. Why is there 1p difference? And I mean, this is going to. I mean, again, I say this just because so you can understand. I don't know. I don't know if you think. Oh, I mean, I hope you don't think. Oh, yeah. How did you know someone like that? We all know strange people. I went to school with a guy who he went to jail for a few years, and I mean, he was an amazing IT guy. And he went to jail because what he did, he used to work. This is many years ago, 1994. What he did was he used to work for NatWest. I don't know if NatWest still exists, but NatWest is bank. I don't see them anymore. I'm sure they are still around. NatWest. And what he did was he wrote a program to deduct 1 penny from all these private accounts. Now, if you think about it, there's no way on earth you're going to know that the pennies gone from your account. It's impossible. You cannot know. If you can know, I'm impressed. You can't know. You just cannot know. Something like 1 penny, 1.5p. And the only way he got caught was because he was spending money somewhere, and they kind of called the bank, and that's how they actually found out the fraud. The truth is, they never actually found the fraud. Even the auditors didn't find the fraud. So the key point here is that we just do not accept any materiality with bank and cash. And I'm sure you can accept the same thing. Why would we accept materiality with share capital and premium? If I'm looking at a statement of financial position and I see your share capital, well, I want to see the share certificates. I want to see the money in the bank. It's absurd to even consider materiality for share capital and premium. It's absurd to think of a materiality for loans. So you can see this question of materiality can only arise on certain balances. It's not this kind of blanket figure that we will accept for everything. Now, also with materiality, again, like I said, the materiality also applies not just to, again, I've moved away from the quantitative to the qualitative, and there are certain controls I would want to see in place, if you like, for which there's just no materiality. So let me explain. So, for example, you can say, but I can see materiality for quantitative. How does it work for qualitative? So, for example, I might say, listen, say, for example, in the authorization of orders when someone is making a sale, and you say, oh, we always sign before we have an order come through, or we always sign before goods are let out of the building, something like that, because I'm walking through the systems. I'm willing to say, okay, I'm willing to accept that 2 out of every 10 invoices are not signed for before they're put into the system, something like that. So I'm looking for the controls in place. I'm looking to see to what extent am I happy that there are actually controls in place. I'm looking for authorizations, if you like, and double signatures. But there's some things I just won't accept anything. I won't accept. I want to see that in terms of wages, again, that we see very clear authorization for. So the finance director will authorize, payroll clerk will finish the work, send the list with all the amounts before it's back to the finance director. Finance director will look through the entire list, check all the numbers, probably to last month's, look for ghost whatever. There'll be a little. The good thing about our work is that there's always a little table that will say checked all the names, check to see for any new joiners, check to see for any leavers, all those little checks to make sure that you're not giving money to some new people and you have people who have left the building no longer collecting cash, and checked that the amounts are reasonable. Literally check through before finally authorizing it, and then if you like, pressing the button, accepting that the button can be pressed. And typically you would have at least maybe 2 people who would maybe press the button. Right, so typically wages, like I say, authorization of capital expenditure, you would want to see, you won't just, like I say, this almost speaks for itself, without boring you, any capital expenditure within the organization, and also the financing of the company. Again, you would imagine, I'm sure, right, that these last 2 would be happening at board level. So I'd be expecting to see a document, a legal document that I might have mentioned that we see all the time, our minutes of meeting. We want to see it's actually, when they ask the secretary or the secretary to record the minutes of the meeting, and it's all looking very serious, it's because it's a legal document. Auditors depend on these documents to say that, and they record everything that happens. Sometimes I've heard things like, I've been in meetings where they stop the meeting and ask the secretary to go out because they don't want it on the record, because the secretary has to record everything on the record. So those meetings, so any capital expenditure, any buying of debt, that sort of thing, all has to be recorded. And like I said, because we accept that there will be issues with these balances, certain balances, we accept that there will be differences, and you and I can disagree on the judgment, but those for those type of balances: trade receivables, inventory, non-current assets, right? Accruals of expenses, things like that. I have to just agree that in line with the framework, it's true and fair, if you like, and people are not misled by those. Cool, great. So, and then again, like I say, then it's my job to then decide and define what tests I will do. So again, like, I think this is just kind of highlighting what I was saying. Disclosures are just as important in determining materiality. I'm also examining the notes here, disclosures pertaining to future legal claims. So it's not always about numerical calculations. So, so there is guidance. There is guidance about materiality. So just look at the time. Okay, great. There is guidance about materiality, and how we arrive at this figure, or the figures that we use to guide us. Now, of course, it's a matter of judgment, and we need to think about a few things, if you like, in order to decide these numbers. I've just been coming up with these numbers, and the thing I found interesting was, when I was training different partners as a firm, that we didn't actually have, we had the standard calculations, as we'll see in a second, but every partner would tweak it and change it a little because of their knowledge of the organization, what balances they felt were riskier, and they would adjust that materiality. So imagine, let me just coming back to this business that had 2 point, where we were willing to go for an overall materiality of 500,000. This 500,000, think about where I'm going here. I have an overall materiality for the entire organization of 500,000. So I'm willing to accept 500,000 across all balances. Now, you and I can go out and do some work, and maybe inventory might be 300,000, and all the other balances might be 150,000. So it's still 450,000. Now, at the beginning, we had this planning materiality of 500,000. We've got here, and it's actually lower than our planning materiality, because we said anything below 500,000 willing to accept, but we might be uncomfortable because, I don't know, another partner might have felt, listen, for me, 300,000 would have been what I would have gone with. Remember, so the question here is that it's such a matter of judgment that you need to be willing to sign your name to, to sort of say, listen, I'm happy with this. So, and you need to decide how you spread that 500,000 across. You might actually say, listen, I will only accept a certain level. So you might actually say inventory, I know it's 500,000, but inventory only 50,000. If it's over 50,000, I'm not happy. So even within the big picture of materiality, you can make decisions. So you can sort of see where I'm going. It's not black and white. It's about judgment to make sure that you're happy when you're signing your name to that sort of thing. Right. Like I say, it's subjective, it's complex, but it's important that you think about it in terms of the client's needs. But we do have standard benchmarks that guide us. So what I'm just going to do is I'm just going to kind of, so what I did was, I mean, sometimes because I've noticed that I'm just going to come out of this and 1 second, I'm just going to come here. I'm just going to share my screen and go through another set of slides very quickly to just kind of break that down a little, just to add to what the textbook is adding, just from personal work, and just so you understand what's really happening here. So I'll go back to those numbers, but so you just understand what's really going on here. So 2 things here. During our risk assessment, we will consider materiality. Now, based on, well, I would have looked at the organization, looked at the external environment, looked at the balances and think, okay, looked at the inherent risks. And now our next topic next week is planning. So during the planning stage, we're actually planning the audit now, so to speak, after risk assessment. I will then determine this figure that we'll come to during the planning stage. Now, just because I have a planning materiality doesn't mean that's what I'm going to end up with. During the audit, I might find more information, or more things might happen, and I might change my materiality. But at the beginning, I should have a planning materiality. So like I said, this isn't just about sorry, can you see my slides moving, by the way? Can you see these slides moving?
Yeah.
Okay, great.
Yes, so
Thank you. Okay, great. So you can see, so this isn't just about the pound value of the error. It's not just about the financial issue. Like I said, I've highlighted it's also about the qualitative issues of disclosures. So we're working with a risk-based approach. Now, the question here is this. When we try and figure out materiality, we need to find a base. When I say a base, what am I testing here? I'm examining an income statement, a statement of financial position, and technically a statement of cash flow, but we don't really use that as a guide. We want to use a base. Now, the other thing is I want to be able to compare 1 year to the next to see whether or not there's business, because that's how I kind of know if there are fluctuations or if there are issues. So ultimately, I'm trying to understand what are the potential key drivers in this organization that I can use as a base to determine a fair figure to say, after this figure, I'm happy, or what base to use. Now, the truth is, the most popular base that most people use, the most standard base that is used all the time, is just profit, because ultimately profitability is what drives incentives. Profitability is what drives whether there will be manipulation. So we know that that's the figure. I'm willing to sort of say, listen, I'm willing to accept a 5% error on profit. And that's it. Anything more than 5%, I'm not happy with. So we need a base to kind of work with. And profitability has always been the core base, if you like, profit before tax, if you like, just because taxes, if you like, depending on the year and the country, it's quite arbitrary. So profit before tax has always been the base by which we work to decide this quantitative, now I emphasize, number, if you like. So that's always been your typical base. Now, we can also use turnover, of course. That could be a base as well. Because again, like I say, these bases must be relevant. They must be relevant. And most businesses, most shareholders, most people are looking at how businesses' profits are doing, and that's what could mislead them, you see. So I need to look at materiality around what could mislead the users. And that's typically profit before tax, turnover. Some people use gross profit. It's not very popular, but it's a potential base. There's nothing wrong with it. It's relevant, it's stable. So chances are that I will also say I'm willing to accept anything. I'm not willing to accept anything over a certain amount here. And also I can see trends with it. I can compare it from one year to the next. That's the issue here. I want to be able to compare one year to the next. Total assets and total equity. These are all potential bases that I can use to determine my materiality. So how do I choose materiality? So like I said, it has to be relevant. It has to be useful as a base, as something I can use. So I have to ask the questions, what are the key objectives and drivers of this firm? What is likely to be stable and predictable, right? What am I likely to see year on year? So I've said to you, profit and loss, all profit-making organizations, most of the time, that's what we're working with. So when we come to talk about the percentages, you'll sort of understand, because people do a lot of work with profit. But now, the problem, of course, is that profit only applies typically to profit-making organizations. So what if I was dealing with charities or schools or government organizations or charities, schools, charities as well? Well, they're not profit-making, if you like. They get funding from the government, so I can't really use profit and loss as a base to look for materiality, problem number one. And what if we are talking about a business that's been making losses? So if a business has been making losses, so that you get the context of this, I can't really use profit and loss as a base for my quantitative materiality, this 500,000 figure I'm looking for. I can't use a business that's making losses. You're thinking, oh crap, what do I do? So if you can't do that, you start thinking, well, and the other reason, again, like I say, is that I'm hoping, again, that there isn't much fluctuation in profit from year to year. So you can see my dilemmas here. I'm looking for something that's stable, well, relevant first and stable. And typically, profitability is stable with most organizations. If it's not stable, then I'm thinking, right, maybe I can't use this as a base. Maybe I need to use something else. So those are the issues really that determine the basis for materiality, picking a figure. Turnover. Now, again, a lot of people look to turnover to see whether an organization is doing well. And this is very normal. The problem with turnover, again, I come back to my fidget spinners, because people are sometimes rewarded on turnover and sales. So that's a fair base, I could say, because that's revenue and that has potential for manipulation. And yes, I can work with that. But again, when you have a lot of fluctuation from one year to the next, I'm trying to set one base every year, and one base across both the income statement and the statement of financial position, as opposed to having different bases and different materiality. I want to just have one materiality for the entire financial statements. So you can see that's the problem, where you have all this, like the fidget spinners, that becomes maybe a problem. So typically, so the rules almost apply that go with profit and loss. If it's a profit-making company, and if there are no losses, that's the kind of general trend. And I'm hoping that, there's a gentle movement across from one year to the next. Gross profit. I mean, I said gross profit. It's not in your notes. It's not in your text. But in practice, gross profit wasn't a bad idea, because typically turnover, the problem with turnover is that, or the issue with turnover alone on its own is that, as you know, that if you go from one year to the next and turnover has gone up, usually it's just purely due to inflation. What do I mean? You have had to buy goods for more. You've had to spend more money buying goods. So you've had to pay more for the goods. So therefore, you literally just transfer the costs to the customers. So by selling it for a higher price. So looking at turnover alone can be slightly deceptive, because you look like you have a greater turnover, but actually looking at gross profit tells us whether it's a real turnover, whether you've kept the costs the same and you've been able to sell for a higher price for whatever reason, if you like. So gross profit tends to move in line, if you like, because these costs tend to move in line as well. So that might be a base, but we don't use it. Total assets could be a good base as well. So if you think about it, when I say total assets, I'm talking about non-current assets plus current assets. Most organizations have their non-current assets, buildings, machinery, the same from year to year. It's unlikely that they're going to be buying and selling very often. So that might be a good base in order to build a number for materiality, right? And that could work. But you and I know that many organizations, in the UK particularly, we're experiencing a shrinking manufacturing sector and a growing service sector, which have fewer and fewer physical assets in-house, and they're having more and more intangible assets, brands. I mean, the other day I was upstairs on the C block and I saw this class full of these digital marketing students, if you like, and that's a whole new area now that's growing. And then you think of your tech companies and you think of your programmers, if you like, and you can't really call the laptops they're working with, if you like, the key assets. It's really the intellectual capacity going on there, isn't it? And the work they're doing and the brands they're building that are the real assets, as opposed to the assets, the sort of the physical laptops they're working with, right? And they might all be working in the cloud, so they're not buying any servers, they're probably just renting out server space. So you can see that things are different. So which is why choosing total assets might not be so popular on its own. And total equity, you can have that because we're looking for stability. That's true, but it's not relevant per se. It's not as relevant because you're not judged so much about the equity in the organization. You're judged pretty much on revenue. You're judged on profits. You're judged on, are you somewhat judged on total assets? I don't know. You're judged on gross profit margins. So we're looking at those things on which you're judged, and where we're likely to see some manipulation. So I can then test the sensitivity in its movement, isn't it? Is what I'm ultimately saying. What is the sensitivity to profit? I don't want to see anything that's over 5%. I'm having issues with any errors here, so to speak. So in effect, in reality, what would happen from a textbook point of view is that we would actually calculate these percentages on all of these things and then find some kind of midway balance. And of course, I would do a textbook calculation, and the riskier the balance was, I would then tweak that figure, if you like, right? So thank you for the textbook figure to the benchmark, and then I would then adjust that, like I was saying, to what I really wanted materiality to be. Cool. So let me go back to my slides, take you back and share this. So this brings me to these benchmarks. So the standard actually gives us benchmarks, that you should and you please will have to kind of learn. They're not hard, but you need to remember these numbers. They don't give it to you in the exam. You just need to remember. So when I say traditional benchmarks, the first one I want you to remember, of course, is the profit before tax. The benchmarks, again, like I say, they're just benchmarks. It's all a matter of judgment, really. The benchmarks recommend that you should set materiality, your planning materiality, at 5 to 10% of profit before tax. So what you're fundamentally saying is that you're willing to accept errors up to this amount. Anything over this amount in the organization, when you do your audit, you're not happy with, right? You're willing to accept errors up to this. So I don't know, again, I'll just give you just a straightforward example. Imagine a business has profitability of, if you like, 100,000. You take, say, if you like, that would have been 10, so say 5,000. 5,000 would be your benchmark, and you go along through this entire audit. You're looking at inventory, you're looking at non-current assets, you're looking at the depreciation, and they've recorded everything on their statement of financial position. You do your own valuations, and you see that your difference, you've calculated everything, and it comes to 4,000. You're okay, you're happy. You're saying it's not material. That's what you're saying. Once it crosses the 5,000 mark, you'll have issues. Right, you see where I'm going, and that's kind of the way we think about it. That's what the quantitative materiality is really trying to do. Again, like I say, that this is what we go with first, the profitability. You can see that turnover is of course bigger than profit before tax, which is why the percentage has to be much smaller. So this is why I'm telling you to start off with profit 5 to 10. If you remember this at 5 to 10%, then we go to turnover. Typically, again, we go to turnover again because we're looking at loss-making businesses, and we're looking at non-profit making businesses. So we look at their turnover and say, okay, take half of their turnover, and we will use that figure as our planning materiality, with quantitative planning materiality, when we walk through the organization to see where and look for our errors and look for our differences, or look for our misstatements, if you like. And that can go all the way down to provisions, if you like, provisions for doubtful debts, accruals that haven't been put through that you think should be put through. Everything, you're literally walking down your statement of financial position and looking for any differences where you disagree with what's actually they claim to as their valuation, if you like. Right. And so, yeah, sorry. And the last one was a half, 1 to 2% of gross assets, 1 to 2% of gross assets. Right. So let's carry on. And then the other thing, the other one, of course, that we also think about is that we have certain things that are material by nature. Now, they're just material. This you just have to kind of learn. Just because of the nature of what they are just material. This has nothing to do with even like kind of like what I was saying earlier on, that cash and bank are material by nature, as in they have to balance. Any 1p difference, then you know you have issues. That's material, you know. There are other things, little things, because again, when any misstatement, so whenever any misstatement is adjusted and it turns a profit into a loss, then it's material. And I'm sure you can see why. Because here's the thing, if I've put through an adjustment, and if as the financial director, I'm currently showing a loss, so I'm thinking, what can I do? Because I know the problem here is once auditors or once shareholders see loss, and if we were profit making in the previous year and now we're showing a loss, then okay, I need to think of something to do, if you like, to kind of you know, it really doesn't even matter. The key point here is that or I need to think of something that I've done that I need to undo, or I need to think of something that I need to do. So classic, let's start from the top, revenue. So imagine I put through a number of sales returns and I'm currently showing a loss. So what I might do is say, oh, listen, I know what I'm going to do. I'm going to remove all these returns and pretend they happened in, if you like, the following year. So you might, again, we'll come to this when we come to talk about evidence. If you sell goods, and again, you might think, oh, yeah, that's interesting. If you sell goods on the 31st of December, so you sell goods on your year end is 31st of December. You sell goods on the 30th of December, 31st of December, say for £10 million. Now, here's the thing. You will recognize debit trade receivable, credit revenue. Hey, profits are good, current assets are great. And current ratios are great. And remember, there's so much connected here because current ratios tend to kind of have an effect on bank overdraft, loan covenants and things like that. But you're looking good. Now, Hannah could say, listen, I'm going to sell goods. Hannah could call Natalie up and say, listen, guys, listen, Natalie, listen, I'm just going to sell you some goods, right? I'm going to sell the goods to you, just receive the goods, and after the year end, return the goods. Now, typically, what would happen is that a normal thinking person would argue that, well, the sales happened in one year and the returns happened in the other year. And the question becomes, should we adjust the sales in the prior year, for example, 2018, as opposed to 2019, based on, well, the goods were returned. Fair enough, the goods were returned in 2019, but the question is, the sales relate, the returns relate to sales in 2018. So if I, as an auditor, so first of all, the standard says that you have to adjust. That's it. But hopefully the financial director is hoping I don't find the returns. He's hoping that I'm just going to walk through this and not see this and just see the revenue and just accept it. But if I find the returns and I now say, well, you're going to have to adjust that, suddenly, once he adjusts that, revenue becomes material, because it means that there is potential here for fraud. I will now go around and make sure that all the returns, because now I'm suspicious that there are more returns that haven't been put through. So it's no longer about the amount, it's about the act, so to speak, if you like, that I need to check what's going on here, right? And I probably will just test all sales returns in the first month of the year, to see which of those relate to sales before the year end, to make sure that all these adjustments are now put through. Because remember, it might just been the odd one or two that I found. Remember, I'm sampling, and then I find out that it's okay. Okay, right. Again, the same thing here. Misstatement when adjusted turns a reported net asset position into a net liability position. So basically, where our liabilities suddenly become greater. Now, again, and I want you to just walk into the shoe. Just think of. I think I highlighted every time. People are always trying to overstate their assets and understate their liabilities. anything to hide. When you're thinking, what could someone be possibly doing to sort of prevent putting on certain liabilities? So maybe they're not going to recognize certain loans, so they've just taken out a loan. I don't know, they've masterfully, cleverly debited bank and somehow manipulated and not credited revenue. Maybe, sorry, credited loan. Maybe they've been very crafty and they've put it in equity. I've seen that before. It's just about putting things in different codes, isn't it? Think about it, you know, so because you know that if you put it in the long-term loan liability, the liability code, it's going to show up under your assets. If you put it in equity, it looks good. So, so it's that kind of thing. That straight away makes you think that directors' salaries and benefits, all directors' salaries and benefits doesn't. It's just material. So basically, you would have a whole section in your audit file where you would literally get a printout of all the directors' salaries and all their benefits, and literally add the whole thing up and check month to month that is the figure. That is the figure, just to make sure, and not just the accuracy, you're actually marrying this figure off to the contract, right? To the contract. Again, you might wonder, oh, what's going on here? You see, because typically many directors, right, will take out loans for themselves, if you like. That's why I wrote and benefits. They take out loans for themselves and not disclose it, if you like. So and I know Natalie's in practice, and James, there's something called, I don't know, I'm sure it's still around, called a Section 419 tax, I think, on directors, where if they haven't repaid a loan back in 9 months, they get a certain tax, I believe, that they have to pay. And I think it's, if it's over a certain amount, it might be, when I was studying, it used to be £10,000 when I was in practice. So the key point is that we want to recognize or clearly outline all the benefits to make sure that all the right tax on those benefits have been paid and people are not abusing the company. Remember, directors work for the shareholders, if you like, and so we need to know what benefits they're taking out and if this has all been agreed by the board for good corporate governance. It even changes the way we think about it changes the way we think about the internal controls. Again, like I said here, all that narrative about legal claims, going concerns, and part of our work when we were doing the risk assessment was to look at the organization as a whole and to look at their kind of forecasts and just to look at the industry, if you like, so that we know that even though this year might be a good year, when we prepare the accounts, the future isn't so bright. So it's about letting shareholders know, listen, the accounts are true and fair for this year, but as we're going forward, it's something you need to think about, right? Again, like I said, it's more about a mixture of working between, again, like I say, getting a total materiality figure and then combining combining that. I just want to get to a nice place to take a break. 1 second, let me just see how much of materiality I have. Right, yes, I think I'll stop. I'll just carry on up to here and then stop. So like I said, typically materiality is determined for the financial statements as a whole, but that's what our starting guide is, if you like. So that's planning, that was planning materiality, and then during the audit, if you like, we might change our minds, and that's what's referred to as performance materiality, right? If you like, as we go along. So the amount set by the auditor is set at less than total materiality. Yes. So this is just to kind of again highlight this at planning. At planning, what we'll do is, like anything, we will set the materiality, and this is referred to as planning materiality. It could change, becomes performance materiality. But what we do is we sort of say, listen, we're only protecting ourselves, really. Different businesses will do it differently. They'll say, listen, we're willing to accept errors up to 500,000, but what we're going to say is, for ourselves, we're only willing to accept errors up till 400,000, right? Now, we will call that 400,000 performance materiality. Right, total materiality, we're willing to really accept, real truthfully, 500,000, but we're not going to talk about, we don't want to hit that point. We just want to kind of work within the 400,000 scale and keep examining and reviewing, if you like. So it just gives us a way to make sure we don't kind of miss out on errors that we could potentially find. yeah, so this is what I was saying. I was talking about. This is what I highlighted. All performance materiality. We know that we're willing to accept up to 10 mistakes, if you like, or whatever. This is total, but we pretend that we're only willing to accept up to 5, if you like. So once we find 5, we raise a red flag and say it's material. But if you like, it just means that we are likely to find out where those errors are. Right. Yes. Good. Great. 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 I think so. That's kind of the story about that, and that kind of covers those pages. That kind of covers the pages in your textbook, page 107, page 108, page 109. Actually, you know what? Sorry, please. Just before we go on a break, let me just take you to page 108 of your textbook, just to kind of show you the numerical working of what I was saying. Just to take you to page 108, just to show you that. Show you how this works. So here are a set of accounts. Right, here we are. So we're preparing for the year 2004. This is our focus, 2004. That's so in England, in practice, what we do is, I mean, because spreadsheets do this for us anyway, we do all three. We do revenue, we look at revenue, profit before tax, and total assets. We do everything. So we take, so for example here, if you take 5% of 1048, you get 52. If you take 10%, of course, of 1048, you get 105. So you have this, you kind of write everything down. So you said, okay, that's the lower threshold, that's the upper, and that you do the same thing for revenue, and you do the same thing for total assets. And then you ask those questions like what I was saying, what's the nature of this business? What are the key drivers? Profit making year on year, everything okay? Yeah, good. This is an interesting one because we can see you can see here that profit has actually gone up by quite a bit and revenue has somewhat stayed the same. So I'm thinking, okay, and total assets have increased as well. So in effect, what we tend to do is there's no right or wrong answer. We look for some kind of range. We look for some kind of range. Now, I could start at 52. I could start at 52. I could have started at 52. It's not the end of the world, but it's quite low. So it means that if you start at 52, if you say that I'm going to take materiality of 52, you're literally saying that anything above 52, I'm not happy with. Do you see where I'm going? So the question here is, you'll be doing lots more work, and again, like I say, depending on the size of the business. So they're saying, listen, it's okay. You can see here, this is 110, this is 97. So maybe we'll start off here at 97, and then we won't go up to, we will sort of pick something between 97 and maybe a good range here, because this is 10%. This is the 10% threshold for profit. So we'll say, okay, now listen, we'll go with the higher threshold for profit because it's profit we really want, but we won't start at 52. We'll start at maybe 97, something along those lines. But there's no hard and fast rule. You'll be told exactly what to do in the exam when we do questions. So don't worry, no one's asking you in the exam to make these judgments just because it's very kind of subjective. Again, like I said, materiality is not normally based on revenue, except when it's not meaningful to base it on profit. Profit is our driver, but this is profit really where we're working with. So that's kind of the key point there that I wanted to highlight. And what am I saying? So if I'm going to go for that benchmark, more than anything, any errors more than 105 is material. Therefore, preliminary materiality will be set lower. So if you like, again, I'm starting here at 97%, which is about 9% of profit, which is about in the range of 5 to 10%. So anything in that range of 5 to 10% of profit is what I'm looking for. It doesn't have to be as low as 5. Anything in the 5 to 10% are the recommendations there for materiality. Cool, great stuff. Let's let's have 15 minutes and let's come back at 11:15 and we'll carry on then.
Thanks all.
Thanks, guys. Awesome. See you in 15. All right, sorry, let me just share. Welcome back. Let's just get my oh, I think that's it. Oh no, that's not the right one. Again. Oops, sorry. Let's new share. Risk. Cool, great, right. Sorry, this is just loading because I think it didn't like us leaving it alone. Cool, right, let's just get that up. Right, brilliant. So now we just go back. I mean, I think we go back a page or two, yes, to page 104. So what I'm talking about here sort of covers, I kind of highlighted these already, the definition of these risks, of these inherent risks here. So again, this chapter is all about risk assessment. And as part of risk assessment, I would need to have considered materiality. What figure am I going to use as my benchmark sort of quantitative risk factor, apart from all the fact that there are things that are material by nature and there is a qualitative materiality. And then we'll come to the sort of risk assessment procedures that we carry out. But again, just understanding this risk, I almost think in simple terms, if you were looking at this from a more management accounting type, even the organization itself could not control. I mean, a dominant CEO is always an interesting one. Is always considered an inherent risk. Just think of all the effects of nature of trade. And think of the internal risks. So when we carry out a strengths and weaknesses type of analysis in your business, we can control risks. We can so still risks and swap risks, and then you can offer a strategy. So again, I'm literally just to cover the text. I think you are make your own flashcards or make your own little notes. Really, audit just transform the material into your own kind of just and not making my you see over I've done on audit and done questionnaire. So you know yourself as well. Okay, great. So inherent risk. I highlighted this already. This is the fact that subject statement is the nature of the word, just the risk of misstatement. Very much related to business risk, right? So these are risks resulting from the conditions, the events of that could affect a business or prevent it from achieving its business objective and goals. I mean, you could go on again. Political, economic, social, legal. We could go on if you like. And there you are. We have inherent risk. Isn't very much we can. So up here where it's saying audit risk, really, it's really inherent risk I'm talking about. But remember that inherent risk and control risk are all part of audit risk. So really, it's inherent risk I'm talking about here. So ultimately, these business risks can lead to complications, which can lead to fraud, error, omission. It's just the nature of the risk itself. So, like, where do we see these risks, especially? I mean, we have a job here. People say things like auditors are wary of restaurants and things like that. Well, now people come cashless. We found the team I was working with very kind of money laundering exercise going on. where you had as well, an area much more rural as the Carmel, and you have London. I think it really copies London. And London is a part of East London. I think near. I think you come out a little bit more plain, but into what we call the and the cash, of course, because when it comes to these restaurants, they were selling the big stock or seconds, whatever, and feeding the money through the restaurants. So it's very exciting. And then so we have cash businesses, we have like risk specialist products requiring specialist knowledge. What's happening with the actual product and how it's costing value. Of people faking that sort of thing. I've put here areas of the risky. So you see that the team should discuss these matters in a planning meeting before deciding on how to approach these buses, and how can we make sure we can get. This is the risk that it's once you hear control risk, you're thinking internal control. There's a whole control. Now you actually worry about how you can sense control is about control sources. They are, but the full control as you get that to prevent errors. Controls the control risk. These examples have a dominant CEO. So yes, actually, forgive me, I was wrong there. I put the dominant CEO under control risk. So inherently, this dominant CEO control, as you really would naturally imagine. Starting work, break. Something I said earlier on is the fact that really just opinion, we put chance to pick the wrong population, right? And then we have non-sampling risk, which is related to sales here. You can't know that very well. It is a matter of having experience. So, and you have the result. So I just your basically here is that it's our responsibility. Supervision levels. Our eyes to what could be happening in the news or in the session. Doing things so that not to allow the coming exactly the same the director just to see you for and give you exactly what you might sound what is important. How you start thinking, okay, I'll just use what I have. So it's about being able to that's the way and then finally critical to the evidence yourself on risk assessment these are procedures. So when we look at as auditors will carry out certain procedures. And you know that when you start writing any answer to, if it says, what are the procedures to do something, because so we're actually doing anything. So once we come into test of detail, which is when we get to chapter 7, when we're looking at evidence pieces, every member and just understand what happens from an order coming in and how it gets authorized, even to order in the case because who would all order an extra because they would and then we need 10 kilograms of something because control there and they came in so we see observation quite popular. So again, this is us, and I put SWOT here because we're trying to looking at controls. We're trying to understand here we are understand organization inquiry. So we can as much as we can to build up a file for this organization. So when we start kind of bouncing our heads and wondering, okay, what if that happened? What if that happened? Right. So risk of course, we want the internal function and like what is the department forgive and regular and the process. In the organization. Understand what management is and what it's like, and then observing all the control procedures. We are in Spain. So we don't think the actual diagrams show how one area is to the next. These documents and manuals, And so really come when I was talking about the organization. So I said it's really important because we can understand this company. What's the competition, the economic conditions, the all this goes and tell you things like it first, and then as you plans to have an idea, it's a bit risky. You have to turning off this any work, anything at all. So it's like products, services, investors, so you have myself heavily geared. It starts getting you thinking about what else is the right place. If the loans you get there, they can pay the loan you have always been business supplies and key customers. Will you before you the figure that is true and fair, where they say always involved in customer suppliers. And then want to know because this could mean the end of their business. If you like, so it's important we understand. Everything to the evaluation. So this kind of takes a lot of time, and this is typically in the planning in the section of the industry. On here, we're looking at the entity's financial performance, just budget forecasts, comparisons of competitors, and consideration of related bonuses. We just want to get an understanding of what's going on here as to where there might be issues. Right. Yeah. So first of all, if the entity has an internal audit function, we just want to kind of understand. I usually argue to this. Department, you may be able to most of the time rely on the control. So we rely on doing your thing. Everywhere we're observing and inspecting and looking at the control. I mean, I've seen little 4 markers on this type of thing. You wrong answers, just trying to find out information about organization, its competitors. So you will of course get all the information, their team. But of course, if you had worked with them before, so you have more your own files now. Everything you have, the client, or if you like, you're looking at their forecast management accounts, and you're all looking at the competitors, what's going on in the industry. But really, what we're really ultimately doing here is to gather enough information to be able to make decisions. Now, materiality was important. Materiality is because even if it's normal for us to be the next, so always. So if I calculate gross profit margin for last year and it's 20%, and I calculate it for this year and it's now remember that I understand if that revenue that you claim, say for example it was 50 million, has happened things. Did it happen this million? I want to know did you sell that year? The cutoff. Right. Is why you have this and you have 12 here. Ridiculous. So here's get to find the ways and colors and balance. I think it's odd if you like moving from one period to the next. There seems something inconsistent, and every balance in the income statement. Well, there's an everything. It's better than so they're always or of assets. Why would you do that? So why has this person put in 15 months? Because invoices, much in so what I'm from once a year a worker you renew relationships. And again, like I said, they are fundamental to the auditing process. They will drive where we go to apply the risk factors. Right. And what do we look at? Years. I mean, we have the software now shows trends from here. Hopefully, I'll pick up any because of information from prior periods. Also, it means I can ask questions if you like and understand instead of yeah, actually, I don't think you've done any exams. Here across the number of employees, so you must see the time was moving together, using staff, and yet your payroll costs going up. So it is what we do all the time. We will see. We'll come to we have computers, especially now from as you know, it's enough like computers I can do a lot of things and test it right from there. Yes, so if you go to page 114 of your textbook, So one day, you will must have begin working out with the boy. Please ask ratio. The quick ratio. If your turnover, if your turnover days are increasing or compared to last year, are still like your a lot of so having a loss for the year means I'm sure you know already the banks have been accused of not extending or freezing accused of not. I've only think they said you can see it in their overdraft. Right. Right. Yes. So, sorry. That I hope that answers my PowerPoint. There's just too many of these things. So let's go to your textbook. I just want to take you through something that just to show you now what you're likely to see here. What you're likely to see. Can you? Sorry, I'm just asking. Can you see? I'm back on the pages. Can you see my pages moving?
Yes, Owen.
All right, thank you, brilliant. So I just want to take you to page 115. So this is how it works. So here's the thing that should make you at least happy in one regard. You will 100% get a question on audit risk. So you know that you're already going to get a question. The exam is on audit. You're going to get a question on audit risk. Now, what does that mean? You're going to get a scenario, right? You're going to get a scenario. The scenario itself is actually fair. The risks are so obvious, if you like. So it's not without a question, you're going to get a question on audit. I don't think I've ever seen, I don't even understand how you would do. And to be fair, they're almost fair in the exams. They almost ask the questions in order. So what do I mean? Typically, you'll get a first question maybe on ethics and acceptance. So a scenario-based question. And then they'll give you the scenario, you'll pull out the ethical issues and then make your recommendations. Then you get an audit question, and then you'll get, or either you'll get this with maybe ethics, and then you'll get a question on evidence, and then you get something on the actual final report, something along those lines. But we always get a question on audit risk. So again, let me be very clear. I was trying to understand the business. When I was trying to understand the business, I spent that amount of time trying to understand the business, trying to understand the business risks, so I would know what areas to spend my time or attach my materiality to. I'm not there to act as a business consultant. I almost don't know how I can make this more, which is why hopefully you have to do, when you do questions, you have to try and send them to me, please, because you might actually be answering a question and think you're actually coming out with an explanation. You probably are, but you might have elements of business there. We don't want any elements of business. We are purely auditing. What we're testing for is whether or not that figure on the statement of financial position is true and fair. It has nothing to do with the business risk. The business risk per se, we could discuss that later on, talking about the going concern. But the figure, we're saying, we're almost actually asking, is it overstated? Is it understated? That's kind of the issue really here with audit risk that we need to be very happy with. So what are they telling us here? They're telling us that this is regularly examined. It is important to answer this question from the auditor's perspective rather than the perspective of the client. Really important there. So you're trying to detect material misstatement. You're not looking, again, like I say, you're not business consultants. You're not looking to identify risks that affect the profitability of the client. We focus, I'm highlighting this because it's so easy to do. And you can see they have highlighted it because it's so easy to do. So it's about the relevant, answering the question. So for example, you can read a question and you can say, again, like I say, it's very obvious to say, oh, these people have been struggling, customers here are struggling to pay debt. You can see, I mean, again, I'm only highlighting because audit, I've said before, is almost like a little game. It's language. So if customers are struggling to pay debt, it's not about, oh, maybe the company will go bust or no. That's for the directors to deal with. Or our profits will be lower, shareholders. No. What does that mean for my figure on the assertions that have been made about the receivable. So currently you have a receivable figure there. Customers are struggling to pay. You've got a receivable figure there of 50 million. I'm sorry, that figure is overstated. That figure is, so you want to be using, you can see here, hopefully you see they've used the word overstated here. They've used the word overstated here. Let me see if they use it here again. This is about disclosure, fine. But you can see that you will always be using this language of overstatement and understatement regularly. And so the risk is that, you see, there's a question, there's a third paragraph of what will you do? So this is the consequence. So this is the actual risk, this is the problem, this is the risk. Then the question of what we will do is pretty much then, can you please write off that debt so that we bring receivables back to its normal or to its rightful amount. So that's the issue. You can see I'm still not even going into the business angle because I'm not interested. You are the directors, you run your business. I'm an independent. I come in here and I want to make sure these figures are what they are. So if you always come back to the idea of, so technically in audit then, whatever you write, ultimately that focuses purely on that figure as to how you would test it, because you and I might even go around about testing something differently. Although to be fair, they are pretty much standard. But if you come up with a creative way to test whether a figure is what they say it is, to make sure it's true and fair for that recognition, then that's fine. So let's kind of just highlight what's happening here. It says customers are struggling to pay debts. So what is it saying here? Receivables may be overstated if irrecoverable debts are not written off. So this is a, however you write this, just have the word overstated. You can say receivables are likely to be overstated. I would go as far as saying, I mean, this is tricky because I don't know the exact scenario. I don't know how long, and I don't know. Do you see what I mean? So maybe it says are struggling. That's why they say may. So that's fine. I would go with that. The whole possibility, sort of receivables may be overstated. Right. So again, it takes time, but you kind of get used to being able to sift out what the potential problem is for your statement of financial position or your income statement. So here it says here the client operates in a fast-paced industry. Now, the thing with, again, like as you can imagine, with operating in a fast-paced industry, is that we need to move stock out quickly. Right, of course. So again, it's just thinking, okay, and you might have some other issue. You might think, well, okay. I mean, technically, this term, the potential here is that, well, it's not overtraining. Is trying to find out what, and it's not. You will see it most of the time to see. Okay, I know they haven't used the word inventory here. You might have been wondering, how do I know it's inventory? In a way, you have to kind of. It comes and you kind of sense, okay, fast-paced industry. Think of your assets, kind of work down. And you might have said, and there's nothing wrong. I'll talk about two things that can happen here, and just to kind of show you. But the first one, if you just work through your assets, your first key asset, of course, is inventory. Remember, these assets are in the statement of financial position. We write things in order of liquidity. So you have your inventory. So the chances are that if things are moving in the fast-paced industry, it's possible that we have inventory that's not moved, if you like, that's not quite shifted just yet. So because we're buying new stock and we're selling and we're buying new stock, but we will have some stock that are there. So there's the potential that we will have inventory, if you like, being overstated. That's one thing. So and what does overstatement mean? It means that inventory is overstated, and therefore, and it's about valuation, and therefore that means that inventory has been the net realizable value is actually lower than the cost that's been recognized. And so the question, sorry, forgive the noise in the background. This is all this homeschooling business. I can't wait for them to go back to school. Oh no, it's actually, I think we go on break this week, or technically break, but it's all very, very noisy every day. So inventory is recognized, and inventory could potentially be obsolete. The second issue, of course, is to do with the other asset of trade receivables. I mean, I know they haven't mentioned it here, but the problem with a fast-paced industry is that in a way you're trying to kind of push stock out and then get new stock in, and push stock out and get new stock in. So you might have said, oh, Ian, I mean, receivables is an issue. If you're selling on credit, you're probably trying to sell as much to this client, and you're probably not chasing back, probably not trying to get the money from your client as soon as possible. So it's possible that receivables are overstated as well, because you're trying to push stock out as quickly as possible. And there you are. I mean, it's also possible that you have to be writing down, if you like, your stock quickly, because if you need to replace it with new stock and get rid of it, if you like. So that in itself is not so much. That's more to just do with the accuracy of revenue, but it's really the final figure, really, right? Because everything I'm talking about here is to do with the year end. So with the statement of financial position, it's really to do with inventories. They haven't given me enough to argue for receivables. It could be, but I'll leave that. Here we are. So this next one, it says revenue is falling due to a recession. The cash flow forecast shows negative cash flow for the next 12 months. So again, like I said here, we will come to talk about this question of, which is what we're studying this, where we've done the planning. It means that this business may be having some going concern issues. It's okay if this year was fine. This year, that's what I'm testing. I'm looking at this year. So this year is fine. It's falling, but it's still okay. We paid our debts, but this business may be potentially going out of debt due to all my external analysis, my pesto. I just need to make a disclosure that we're having issues, right, guys? And so it's a potential going concern issue, and we'll talk about that. I just need to disclose. If I haven't disclosed, well, then that's material, right? Because those disclosures are material. So it's not about the numbers. The numbers are fine. It's okay for revenue to fall year on year. When I say fine, they're not fine from your business point of view, but they're fine from me, as long as you're recognizing the truth. That's actually what's happening. I just then have to make a disclosure. You just have to make a disclosure, as in the directors, to your shareholders or to your potential buyers, that we have this issue of potential going concern. Right. So the key point is not about the going concern. It's about the disclosure of the going concern. Right. So please get used to this. You might forget, it's the disclosure, adequate disclosure of the going concern, not that they're having going concern issues. That doesn't mean anything for you as the auditor. Right. Good. Great stuff. So again, like I say here, our aim here is to state what the potential assertion, and when I talk about assertions, when we come to talk about this question of cutoff or valuation or completeness, we want to use that language in what we're sort of we're sort of saying, if you like. And here it says state the financial assertion being affected. You're just really highlighting, if you like, here what the issue is here. So I mean, here ultimately valuation is just talking about these things here. Here we're talking about the valuation of receivables, if you like, because it's overvalued. We're talking about the valuation of inventory. Here we're talking about the completeness of disclosures, if you like. So really, that's what they're really saying here is audit is really a technical subject where we're just highlighting what the problem is. We can see that we have we don't have the right valuation of receivables, and therefore potentially there's the risk that receivables have been overstated, leading to a potential misstatement. So that's really just what we're trying to do. Yeah, I mean, if you can, it's not always the case, because again, like whether it's just really looking to see whether or not what the risk is here, if it's inherent control or detection. But hopefully, as you do questions and I mark them, if you like, you will see that. So you can see here, this is, yeah, you can see here, it's really about writing the right and how we deal with this. And we are really so specific. So I'm going to do this one. And so you see examples of how specific we are to doing it. So people, like I say, I think audit is kind of thing that without knowing anything, you could go in there and get 40, 41, 42. To pass, 43 even, to pass, you just need to write the language down and you're through, right? Because you kind of know. So for example, sorry, 1 second, excuse me. Oh, sorry. So for example, let's look at this issue here of audit risk, like what we said earlier on. So we said that we had the scenarios where the customer was struggling to pay debt. Now, again, like once we start doing questions and I go through them with you, if you ever get a question where you see something like they tell you, oh, find what is the audit risk and the relevant response. Now, if you write, oh, customers are struggling to pay, the question is very, I mean, it's unfortunate. I just restated right. Whenever you say what's the audit risk, what you have to also write is, some questions are kind and they'll say, what's the audit risk, what's the consequence, and what's the relevant response. If you say a question says, what's the audit risk and what's the relevant response, you still have to write what the consequence is. You still have to write the consequence. And when you look at the mark scheme, you see they give you half a mark for stating what the actual issue is, half a mark for stating what the consequence is, and maybe, yeah, sometimes you get like it'll be a 15 marker or something, but like 1.5 marks per point, and half a mark for stating the relevant response. So you want to literally, every time you think of audit risk, you want to think, I need to write what the problem is, and I need to write the consequence. Consequence will always be overstatement or understatement, overstatement or understatement, overstatement or understatement, all the time. The response. So again, like I said, you and I would probably come to the same agreement. I suspect that these people, because you see, let's take receivables. Let's forget I didn't know anything about audit. I'm recognizing 10 million at my year end, 31st of December. Now, what does that mean? I'm saying that 10 million of receivables, I am owed 10 million. It exists. The valuation is 10 million, and I will receive this 10 million over the next coming months. So, okay, that's what you're saying. Well, all I have to do is wait and just check the bank to see if you receive it. So the technical term is after date receipts. So what you'll technically always see auditors doing is that when they're looking at receivables, they will take, if you like, they will literally take that balance at the year end. Let me be clear. There's valuation, there's existence. So existence at the year end, 10 million, no problem. I can call up, imagine there are 10 of them, 10 people, each owing you £1 million. I can call up all of them and say, hello, did you owe Oyen or did you owe Dudley 1 million at the 31st of December? They'll all say yes. I'll be saying, thank you very much. I'll tick existence. Valuation, I will then literally look to see how many of them have paid Dudley, say 2 months into it. I'll turn up in March. And if only 8 of them have paid him, the concept of prudence says that, well, he's only going to get 8 million. So he really only should have, using his experience of the fact that he usually loses a certain amount, he should only recognize 8 million and not 10 million, although he was owed 10 million at the beginning. So then what I then do is write off 2 million, or recommend he writes off 2 million. So you can see here, it literally says inspect after date or year end cash receipts from the customers to see if the post year end proving debt is appropriately valued. Basically, see if you actually received the money, right? And if not, look for any old debts which may not be recoverable and discuss the need for an allowance to be made. So again, that 10 million could be made up of debt that is owed to me in June, July, August, September. I basically want to see if the money has come in. So I'm still taking the year-end debt of 10 million and just asking when it's come in. If it's come in, it doesn't matter if it was owed to me since February. If it's come in when I test it, no problem. It's the ones that haven't come in that I will now ask, when were you to get this money? And then you tell me, oh, and I've been owed it for 7 months. And I'm like, I'm sorry, dude, you have to take that out. Right, and let's look at so this is what I was saying earlier on. So again, when we discuss inventory, might even take up a whole class. This question of looking at inventory, right? First of all, you'd have been to the stock take, first of all, and that's the first thing. And you would have identified slow-moving inventory. Every organization will have a list of its closing inventory. They must do, right? Just think of it as as a database, if you like, and the dates of when all the inventory arrived. if you like, and how the fact that the inventory hasn't moved, if you like, and so you can identify very quickly slow, old moving inventory. It's not even very tricky. And then sort of understand and compare that at cost to what it's currently selling for, or if it's currently selling. And because inventory has existence, basically a stock take is very much about existence, right? You're going around to see if that inventory actually exists. You probably won't do any valuation work on your day of your stock take on the 31st. You do all the valuation post, of course, and then you start looking and identifying slow moving inventory, right, to sort of understand. But again, it goes back to this, we'll come back to the different assertions. Like you can hear me, I keep saying for statement of financial position, I keep saying existence, I keep saying valuation, I keep saying completeness, if you like. With my income statement, like revenue, it's not about existence, it's about, did it happen, did it occur, if you like, is everything there complete, and cut off, is everything in the right period, because that's what's happening, isn't it, with these are period movements, isn't it, with the income statement, revenue in a 12-month period. I have my assets forever, so I can't be doing cutoff with that. So I'm doing cutoff with my revenue, with my sales returns, with my purchases returns, that sort of thing. Right, and discuss that. Yes. Yeah, and then finally, and by reviewing the forecasts and the assumptions in the forecast, will help me understand whether or not this company is actually in trouble. This is also a judgment one. It's almost depends on. We're looking at, can we trust the person who's done the forecast, and can we trust the figures involved? We compare it to the industry. And remember, it's about the disclosure. We're not there to help them. We're just wanting them. We need to decide whether or not there's sufficient enough information or whether they should be disclosing that there is a problem. And that's a matter of judgment anyway, because the directors probably don't want to disclose it, because once you disclose it, we'll come to with these reports, the opinion is not modified for the year. The opinion it's true and fair for the year, but the audit report is modified because there is something to look at, and this is a going concern about the future. So hopefully that starts to get you thinking that there is us looking at the financial statements themselves, which can be fine, true and fair, unmodified, no problem, but there are other issues to do with the future of this business that people should know about. Right, great stuff, guys. Right, yes. So sorry, bashing. What we need to do is, please, as usual, I'm going to do some. Where are we? Yes, I think chapter 5. Yeah, I think now what I'll do is, not today, but what I'll do is, over during the week, I'll send you some questions you can start doing from the exam kit. But please, I think as a good kind of just slowly, why not? You can do the TY, do the TYU1, do TYU1 and do TYU1, 2, and 3, and just send me a sample of your work, especially either TYU1 or TYU3, to kind of see if you're happy with being able to pick out. It just becomes second nature, honestly. So you want to start early, just getting into the habit of being able to identify audit risks, and then focus focus on someone's not happy getting a bath, and then focus on the I'm losing my train of thought there, focusing on the actual audit tests, the actual audit tests you will do. Sorry, not audit. Look, I can't think anymore. Focus on what the actual audit risk is as as a result of my daughter starts screaming, "Daddy, Granddad," whenever they're giving her a shower. It's crazy. I don't understand why I can't do anything for her. So you have the issue, and then you pick up the audit risk, and then you have the response. So it's just getting into some kind of train of thought. I know we haven't fully done responses, but as we get there, we start. So I think for now, what you'll notice, the questions will only stop at identify the problem, highlight the audit risk, right? And those are the big words you want to use. And then by the next chapter, we'll start seeing the responses that we can do, because we would have done the chapters on collecting evidence, so we would know what type of tests we can do to pick up these things. Cool. Great stuff. Is that good? Are we good?
Yeah, that's really good, Ryan. Thank you.
No worries. Awesome. Cool. Great
Yeah,
stuff.
brilliant. Cheers,
Cool.
Owen. Thank
No
you.
worries. Have a great week. Yeah, let's carry on, and I'll see you next Friday.
See you later. Thank you.
Cheers.
Thanks.
See you later.
Bye.
Bye bye.
Bye, everyone.
No worries. Bye bye.